There is a pile on Warren Buffett's desk. It's not a pile of annual reports for companies he's about to buy. It's not a stack of urgent memos or breaking news alerts. It's a pile of things he has already decided to ignore. He calls it his too hard pile. And understanding the profound power of that pile, of that simple act of intellectual sorting, is more important than any stock tip you will ever receive. It is the architectural blueprint for a fortress of wealth, a system of thought designed not just to make money, but to prevent its catastrophic loss. Most people believe that the secret to great investing, to great executive decision-making, lies in finding the right yes. They hunt for the next revolutionary technology, the next disruptive startup, the next hidden gem that will multiply their capital 100-fold. They spend their days chasing complexity, believing that the greater the complexity, the greater the reward. But the Oracle of Omaha, a man who has compounded wealth on a scale that defies comprehension, built his empire on a diametrically opposite principle. He understood that the most valuable word in an investor's vocabulary isn't yes, it's no. The journey to financial freedom is not a mad dash to accumulate 1,000 slivers of information. It is a disciplined march toward a few powerful, unassailable truths. This isn't a story about being the smartest person in the room. It's a story about knowing, with absolute, unshakable certainty, the precise dimensions of the room you're in. It's about having the financial discipline to never take a single step outside of it. We are going to deconstruct this powerful mental model, this core tenet of Warren Buffett's advice, piece by piece. We will explore the architecture of this idea, the psychological traps it helps you avoid, and the practical, tangible steps you can take to build your own too hard pile, creating a moat of capital preservation around your financial life. This is the master key to risk management, a lesson in investor education that separates the amateur from the professional, the gambler from the owner. This is the final promise of a rational mind, the promise that by understanding what to ignore, you can finally focus on what truly matters. Our first pillar in understanding this philosophy is about constructing the very framework of your knowledge. We'll call it the architecture of ignorance, defining the perimeter of your competence. It's not about how large your circle of competence is. It's about how clearly you have defined its edge, acknowledging that perimeter is the first and most critical act of financial discipline. The foundational anecdote for this principle is perhaps Buffett's most famous act of omission, a period where his discipline was tested on a global stage and he was openly mocked for being a relic of a bygone era. The setting is the late 1990s. The world was in the throes of the dot-com bubble. A new paradigm had taken hold. Old metrics like earnings and book value were declared dead. The new measures were eyeballs, clicks, and burn rates. Companies with no profits, no tangible assets, and often no clear business model were being valued in the billions of a few months after their IPO. Technology was not just a sector, it was a religion. And in the high temple of this new religion, Warren Buffett was a heretic. While Wall Street analysts and day traders were minting fortunes on stocks like Yahoo, GeoCities, and Pets.com, Berkshire Hathaway was holding steady with its boring portfolio of insurance companies, furniture stores, and candy manufacturers. The pressure was immense. Barron's, a leading financial publication, ran a now infamous cover story in 1999 with the headline, "What's Wrong, Warren?" The article painted him as a man who had lost his touch, an investor hopelessly out of sync with the new digital economy. At Berkshire's annual meetings, shareholders would ask, almost pleadingly, why he wasn't investing in technology giants like Microsoft or Intel, companies that were clearly dominant and changing the world. Buffett's response was always the same, a masterclass in intellectual humility. He would say that he had no special insight into their businesses. He admired Bill Gates and Andy Grove, the respective leaders of Microsoft and Intel, and he believed they were brilliant managers running phenomenal companies. But he couldn't, with any degree of certainty, predict what their competitive landscape would look like in 10 or 20 years. The technological pace of change was simply too fast for him to have a knowledge advantage. He couldn't answer the crucial questions: who would be the winner in a decade? What new technology might emerge to disrupt the current leader? The entire industry, for him, went into one place, the too hard pile. The climax of this public trial came in July of 1999 at the exclusive Allen & Company conference in Sun Valley, Idaho. This was the gathering of the media and technology elite, the very titans whose stocks Buffett was refusing to buy. He was invited to speak, and what he delivered was a quiet, logical, devastating critique of the mania surrounding him. He didn't shout. He didn't condemn. He simply laid out the historical parallels, comparing the current frenzy to past bubbles in aviation and automobiles. He explained that while a new industry can change the world, it doesn't mean that investors in that industry will make money. In fact, historically, the opposite was often true. He used a simple analogy, one that has become central to his investment strategy. He said investing is like a baseball game where the pitcher is throwing you opportunities all day long. You can stand at the plate and watch hundreds of pitches go by. Tech stocks, biotech stocks, international currencies. In this game, there are no called strikes. You can wait for months, even years, for the perfect pitch, the one that comes right down the middle of the plate, the one you know you can hit out of the park. That pitch, for him, was a business he understood completely. The high-flying tech stocks of 1999 were like a 100-mile-per-hour fastball high and outside. To swing at it would be foolish. The crowd, steeped in the euphoria of the moment, was largely unmoved. But less than a year later, the bubble burst. The Nasdaq, the tech-heavy index, began a catastrophic collapse, falling nearly 80% from its peak. Companies that were worth billions became worthless overnight. Fortunes were vaporized. The new paradigm was revealed to be the same old speculative mania dressed in digital clothes. And Warren Buffett, the man who was out of touch, saw his company, Berkshire Hathaway, not only preserve its capital but thrive, using the cash it had patiently conserved to buy assets from those who had been forced to sell in the downturn. This was not a lucky guess. It was the result of a rigidly defined circle of competence, a masterclass in portfolio protection built on the simple, powerful act of defining what he did not know. The psychological principle underpinning this incredible display of discipline is a powerful counteragent to one of the most common cognitive flaws, the Dunning-Kruger effect. Coined in 1999 by psychologists David Dunning and Justin Kruger, this effect describes a cognitive bias whereby people with low ability in a specific domain tend to overestimate their own competence. In short, they are too ignorant to recognize their own ignorance. The world of investing is a perfect petri dish for the Dunning-Kruger effect. A novice investor buys a stock based on a tip from a friend. The stock goes up in a bull market. The investor doesn't attribute this to luck or a rising tide lifting all boats. They attribute it to their own innate genius for stock picking. This initial success creates a dangerous feedback loop of overconfidence. They begin to believe they have a feel for the market. They venture into more complex areas, options trading, speculative biotech, cryptocurrencies, believing their initial success is a transferable skill. They mistake luck for a knowledge advantage. They are standing on the peak of what Dunning and Kruger called Mount Stupid, blissfully unaware of the vast landscape of knowledge that lies below them. Warren Buffett's entire approach is the polar opposite. It is the embodiment of what you might call intellectual humility. His famous quote, "It's not about being smart, it's about being rational," speaks to this. He operates with an acute awareness of his own cognitive limitations. The circle of competence is not an admission of weakness. It is a declaration of intellectual honesty. It is the hallmark of a true expert. A true expert doesn't claim to know everything. They are intensely aware of the boundaries of their expertise. A brilliant cardiac surgeon wouldn't attempt to perform brain surgery. A world-class physicist wouldn't offer opinions on molecular biology. Buffett applies the same specialization to business. This approach also serves as a powerful defense against another pervasive bias, the illusion of control. This is the tendency for people to overestimate their ability to control events. In the market, this manifests as investors believing they can outsmart a complex, chaotic system. They create intricate spreadsheets, follow technical chart patterns, and listen to financial news 24/7, all in an effort to feel in control. They believe that by gathering more information, they can predict the unpredictable. Buffett understands that most market movements, especially in the short term, are utterly unpredictable. He knows he cannot control the economy, interest rates, or geopolitical events. So instead of trying to control the uncontrollable, he focuses on the one thing he can control: the businesses he chooses to own. By only investing in businesses whose economics are simple, stable, and predictable, he dramatically reduces the number of variables he needs to worry about. He isn't trying to predict the weather, he's trying to buy a ship that is so strong it can withstand any storm. The circle of competence, therefore, is a psychological fortress. It protects him from the arrogance of the Dunning-Kruger effect and the folly of the illusion of control. It keeps his decision-making grounded in the humble reality of what he actually knows, not what he wishes he knew. So how do we translate this from the philosophy of a billionaire to a practical tool for our own financial lives? We need an applied mental model, a blueprint for defining our own circle of competence. Let's call it the 3 concentric circles method. This is an active, written exercise, not a passive thought experiment. It's about making your intellectual boundaries tangible. You will need a pen and paper or a blank document on your computer. First, you draw the innermost circle. This is your circle of deep competence. The rule for entry into this circle is brutally simple. You must be able to explain the business or industry to an intelligent 10-year-old, and they must be able to understand it. Furthermore, you must be able to explain, in simple terms, why this business will still be successful in 10 years. What is its durable competitive advantage? This is not a test of your intelligence, it's a test of your clarity of thought. For some, this circle might contain the industry they've worked in for 20 years. A software engineer might truly understand the business of enterprise software as a service. A retail manager might deeply understand the logistics and consumer behavior that drive a certain type of brick-and-mortar store. A doctor might understand the business of private practice or hospital administration. Be brutally honest. It's not enough to be a tumber consumer dumber died of a product. You might love your iPhone, but do you truly understand the economics of semiconductor fabrication, global supply chain logistics, and the platform economics of the App Store? If not, Apple for you is not in the inner circle. The goal is not to have a large inner circle. A small, well-defined circle is infinitely more valuable than a large, fuzzy one. For most people, this inner circle may only contain 1 or 2 industries, if any at all. That is not a failure, it is the beginning of wisdom. Now, you draw the second, larger circle around the first. This is the circle of familiarity. This is where you place industries and businesses that you know about, but do not understand at a fundamental level. You might have read a few books on banking, so you know the difference between investment banking and commercial banking, but you couldn't confidently analyze a major bank's balance sheet and its exposure to interest rate risk. You might follow the electric vehicle market and know all the players, but you don't have a deep knowledge advantage in battery chemistry or manufacturing scalability. This circle is the danger zone. It's where the Dunning-Kruger effect lives. It's where you know just enough to be dangerous, to fool yourself into thinking you have an edge when you don't. The purpose of defining this circle is to explicitly label these areas as off-limits for serious investment. They are for learning and observation only. Finally, you have the vast space outside the second circle. This is the outer circle of proud ignorance. This is your too-hard pile made manifest. Here, you list everything you have actively decided not to spend any mental energy on: complex biotech, speculative cryptocurrencies, currency trading, commodities futures. The act of writing them down is a powerful commitment. You are giving yourself permission to ignore the headlines, to tune out the noise, to say with confidence, "I don't know and I don't need to know." This 3 concentric circles document becomes your investing constitution. Before you consider any investment, you must first ask, where does this fall on my map? If it is not squarely in the tiny inner circle, the decision is already made. It's a no. This rigorous process of self-interrogation is the first step in building a truly professional investment strategy, moving you from a passive speculator to a disciplined capital allocator. Now let's explore the opposite approach, the path that 99% of market participants follow. This is the antithesis, the way of thinking that the circle of competence is designed to prevent. The antithetical investor is what we can call the jack of all trades, master of none. Their guiding philosophy is not depth, but breadth. They believe that to be a good investor, they must be on top of things. This means they start their day by scanning financial news headlines, checking the pre-market futures, and reading a dozen different newsletters, each touting a different opportunity of a lifetime. They hear about a breakthrough in gene editing and spend an hour reading a high-level article about CRISPR technology. They see that a particular cryptocurrency is soaring and they join a Discord server to learn the lingo. They hear a pundit on television recommend a fast-growing cloud computing company, and they pull up its stock chart. They mistake this constant stream of information for education. They believe that being informed about everything is the same as having a knowledge advantage in something specific. Their process for stock picking is reactive and scattered. They don't have a predefined area of focus. Their research is a mile wide and an inch deep. They might spend a weekend building a financial model for a company, but their assumptions are based on superficial knowledge, gleaned from analyst reports rather than a deep, first principles understanding of the industry's competitive dynamics. Because their knowledge is shallow, their conviction is brittle. When a stock they own falls 20%, they don't have a bedrock of deep understanding to fall back on. They can't confidently say, "I understand this business, the market is wrong, this is a buying opportunity." Instead, they panic. They search for news that confirms their fears. They see the talking heads on TV express doubt, and their fragile conviction shatters. They sell at the bottom, crystallizing a loss. Conversely, when a stock they own doubles, they have no framework to determine if it is now overvalued. Is the price rise justified by fundamentals, or is it just market euphoria? They don't know. So they either sell too early, cutting their winners short, or they ride the wave all the way up and all the way back down, giving back all their gains. Their portfolio is not a curated collection of well-understood businesses. It's a chaotic museum of hot tips, recent trends, and half-baked ideas. It's a direct reflection of their scattered attention. This approach is not just ineffective, it's exhausting. It creates a state of constant anxiety, a feeling of being perpetually behind, of always missing out on the next big thing. It is the very definition of a strategy destined for mediocrity at best and catastrophic loss at worst. It is the direct result of failing to build that initial architecture of ignorance, of failing to define the perimeter. The financial connection between defining your circle of competence and building real lasting wealth is direct and profound. It all comes down to a redefinition of the word risk. For most people, and indeed for much of modern financial theory, risk is equated with volatility. A stock that bounces around a lot is considered risky, while a stock that is stable is safe. Buffett has a much more practical and useful definition. Risk is not knowing what you're doing. When you invest in a complex biotech company based on the hope that its Phase 3 drug trial will succeed, you are not investing. You are speculating on an outcome you cannot possibly predict. The risk is not that the stock is volatile. The risk is that you have no genuine insight into the probability of success. The financial consequence of this is that you expose yourself to the possibility of a permanent loss of capital. If the drug trial fails, the stock may fall 90% and never recover. This is the kind of event from which a portfolio cannot easily rebound. Let's quantify this. The primary rule of investing, as Buffett famously says, is rule number 1, never lose money. Rule number 2, never forget rule number 1. This isn't a clever quip, it's a mathematical reality. If you have a portfolio worth $100,000 and you suffer a 50% loss, you are left with $50,000. To get back to your starting point, you now need to achieve a 100% return on your remaining capital. A single large loss sets you back years, not just in terms of capital, but in terms of the lost time for that capital to compound. A portfolio built exclusively from businesses inside your circle of competence has a fundamentally different risk profile. Because you understand the business's economics, its competitive advantages, and its likely future trajectory, you can make a rational assessment of its intrinsic value. This gives you a powerful anchor during times of market panic. When the stock of a wonderful business you understand goes on sale, you are able to buy more, not sell in fear. This is portfolio protection in its purest form. Look at the tangible results during the dot-com bust. From the peak in March 2000 to the trough in October 2002, the Nasdaq index lost 78% of its value. An investor with $1 million in a Nasdaq tracker fund would have seen their portfolio shrink to $220,000. In that same period, Berkshire Hathaway's book value per share, a good proxy for its intrinsic value, actually increased. By simply avoiding the area he did not understand, Buffett not only preserved his capital, but was in a position of immense strength when the dust settled. The ultimate financial advantage of the circle of competence is capital preservation. By avoiding the big mistakes, you ensure that the unstoppable engine of compounding can work its magic over the long term. It transforms investing from a game of high-stakes poker into a game of disciplined, methodical accumulation. It is the foundation upon which all truly great fortunes are built. The second pillar of our structure moves from the abstract definition of boundaries to the concrete, daily practice of rejection. This is the power of the too-hard pile, the active art of rejection. It's not enough to know what you don't know. You must build a system to ruthlessly and efficiently discard anything that falls outside your circle. This requires more than just intellectual honesty. It requires a form of operational discipline. A harrowing chapter from Buffett's own career serves as the foundational anecdote for this pillar, an experience that burned into his mind the immense danger of operating in a business you don't truly understand. The year was 1991, and the company was Salomon Brothers, a legendary Wall Street investment bank. Berkshire Hathaway was a major shareholder, having invested $700 million in preferred stock a few years prior. Suddenly, a scandal erupted that threatened to destroy the firm entirely. A rogue trader had been submitting false bids at U.S. Treasury auctions, a massive violation of federal law. The firm's leadership, including its CEO John Gutfreund, had known about the misconduct for months and had failed to act decisively or report it. The U.S. Treasury threatened to ban Salomon from bidding at its auctions, a move that would have been a corporate death sentence. The firm was hemorrhaging money and clients, its stock was plummeting, and its very survival was in question. In the midst of this five-alarm fire, the board turned to Buffett. He was forced to step in as the interim chairman to save the company and his own investment. Suddenly, the man who loved simple businesses like See's Candies and the Buffalo News found himself at the helm of an incredibly complex, fast-moving, high-leverage Wall Street trading firm. It was the epitome of a business outside his circle of competence. His task was to navigate a minefield of legal challenges, placate angry regulators, restore market confidence, and reform a corporate culture he found deeply alien. He later described the experience in his letters to Berkshire shareholders. He talked about the immense complexity of Salomon's balance sheet, which was filled with derivatives, swaps, and other exotic financial instruments that were nearly impossible for an outsider to fully comprehend. He was shocked by the compensation system, which incentivized risky short-term behavior. He famously told Congress, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." During his 9 months in charge, he worked tirelessly, often sleeping just a few hours a night. He successfully negotiated with the Treasury, installed new leadership, and implemented new compliance systems. He saved the firm. But the experience left a profound scar. He realized he was playing a game where he didn't understand all the rules, and where hidden risks could emerge at any moment to blow up the entire enterprise. He was operating in a world of known unknowns and, even more terrifyingly, unknown unknowns. When he finally stepped down, his relief was palpable. The Salomon Brothers crisis became a powerful, visceral lesson. It wasn't just an intellectual exercise anymore. He had stared into the abyss of a business that was fundamentally too hard to understand and manage from a distance, and he resolved to never again put himself or Berkshire in that position. This experience fortified his commitment to the too hard pile. It was no longer just a good idea, it was a survival mechanism. It cemented his investment strategy of sticking with simple, predictable businesses where the risks were understandable and the operations were transparent. He had learned firsthand that the profits you might gain by venturing into a complex field were rarely worth the catastrophic, unquantifiable risks you were forced to assume. The psychological principle that makes the too hard pile such an effective tool is its power to combat decision fatigue and choice overload. In his groundbreaking book, The Paradox of Choice, psychologist Barry Schwartz demonstrated that while we may think we want more options, an overabundance of choice often leads to anxiety, paralysis, and dissatisfaction. When faced with hundreds of potential options, whether it's jams in a grocery store or stocks in the market, our brains become overwhelmed. The cognitive load of evaluating each option becomes too great. This leads to several negative outcomes. First, it can lead to analysis paralysis, where we are so overwhelmed by the number of choices that we end up making no decision at all. An investor might spend weeks researching dozens of companies, becoming so swamped with information that they never pull the trigger on any of them. Second, it can lead to poorer decisions. When our mental energy is depleted from making too many small choices, the quality of our subsequent decisions deteriorates. We start to rely on shortcuts, heuristics, and emotional impulses rather than rigorous analysis. This is decision fatigue. A Wall Street day trader making hundreds of trades a day is a prime example. By the end of the day, their ability to make rational, calculated decisions is severely impaired. The too hard pile is a preemptive strike against this entire psychological minefield. It is a system designed to drastically reduce the number of choices that require your serious attention. By creating a set of simple, brutal filters, you can eliminate 99% of all potential investments before they have a chance to consume your precious mental energy. This is a profound shift in mindset. Instead of starting with a universe of 10,000 stocks and trying to find the one to buy, you start with a universe of 10,000 stocks and find 990 to immediately discard. This act of rejection is not a passive process. It's an active, empowering one. It's a declaration that your time and attention are your most valuable assets. Furthermore, this practice is a powerful antidote to the fear of missing out, or FOMO. FOMO is a primal emotion that drives a huge amount of irrational financial behavior. We see a stock soaring and feel a pang of regret for not owning it. This emotional pain can compel us to jump in late, often near the peak, just before a crash. The too hard pile reframes this entire dynamic. When you see a complex biotech stock or a speculative cryptocurrency skyrocket, you don't feel FOMO. You feel a sense of relief. You think to yourself, that was never a pitch I was going to swing at anyway. It's not in my area of expertise. I'm glad I didn't get caught up in something I don't understand. It transforms potential regret into a validation of your disciplined process. By systematically rejecting the vast majority of opportunities, you conserve your cognitive resources for the few that truly matter, allowing you to go deep, build real conviction, and act decisively when the perfect pitch finally arrives. To make this practical, we need an applied mental model for building and maintaining our own too hard pile. Let's call this blueprint the inversion test. This is a powerful mental tool, popularized by Charlie Munger. Instead of asking what are the characteristics of a great investment, you invert the question and ask, what are the characteristics of a terrible investment that I should immediately discard? This shift in perspective is incredibly powerful for rapid disqualification. Your task is to create a personal checklist of too hard triggers. This checklist will be your bouncer, standing at the door of your mind, turning away unsuitable investment ideas before they can even get in. Here's how to build it, step by step. Step 1. Brainstorm your disqualifiers. Think about the things that make a business difficult or impossible for you to understand and analyze. Your list might include triggers like these. The business model is a black box. For example, the profitability of a complex financial institution that relies heavily on derivatives trading. If you can't draw a simple diagram showing how it makes money, it's out. The technology is too fast-moving. Think of industries like semiconductor manufacturing or social media, where the competitive landscape can be completely upended in just a few years by a new innovation. If you can't predict the winner over a 10-year period, it's out. The financial statements are opaque or incomprehensible. Some companies use aggressive accounting techniques or have overly complex corporate structures that make it difficult to discern the true state of their financial health. If you can't understand the footnotes in the annual report, it's out. The business depends on a single key person or a genius CEO. What happens if that person leaves or has a health issue? This introduces a key person risk that is hard to quantify. The business relies on factors outside of its control, like commodity prices or government regulation. A gold mining company's profitability is largely dependent on the price of gold, which is unpredictable. This introduces a level of uncertainty that makes long-term forecasting nearly impossible. Step 2. Formalize your checklist. Write these triggers down. Make it a physical or digital document. This is your personal investment policy statement for what you will not do. Having it in writing prevents you from making emotional exceptions in the heat of the moment. Step 3. Apply the checklist mercilessly. Every single time a new investment idea crosses your path, whether from an article, a friend, or a news report, your first action is to run it through the inversion test. Go down your checklist. Does the business trigger one or more of your disqualifiers? If it does, the analysis stops immediately. The idea goes straight into the too hard pile. There is no further research. There is no, I'll just take a quick look. The decision is final. This system is designed for speed and efficiency. It prevents you from wasting countless hours investigating businesses that you are ultimately unqualified to own. It instills a powerful sense of financial discipline, forcing you to say no over and over again, which is the secret to being able to say yes with immense conviction when the right opportunity finally presents itself. Now let's look at the antithesis, the flawed approach taken by the vast majority of aspiring investors. We can call this archetype the opportunity hoarder. This individual believes that more research is always better. Their browser is a chaotic mess of 50 open tabs, each one representing a different stock or a different industry they are looking into. Their desktop is cluttered with downloaded annual reports and analyst presentations that they will never have time to read in full. They subscribe to multiple investment newsletters and services, creating an endless fire hose of ideas and recommendations. They feel productive because they are constantly busy, constantly analyzing. They build sprawling watch lists with hundreds of stocks sorted into dozens of categories. They might spend an evening researching a solar power company, the next morning looking into a regional bank, and the afternoon reading about a pharmaceutical firm. They are information gatherers, not insight synthesizers. The opportunity hoarder's fundamental mistake is that they never achieve the level of depth required for true conviction. Because their attention is spread so thin, their understanding of any single business remains superficial. They know a little bit about a lot of things, but they don't have a deep, proprietary insight into anything. This lack of conviction has disastrous financial consequences. When the market panics and their stocks fall, they don't have the deep knowledge to hold on. They might have read the last 2 quarterly reports, but they haven't read the last 20 annual reports. They don't have a visceral feel for the company's culture, its long-term strategy, or the character of its management. So they sell. Their portfolio is in a constant state of churn. They are always buying the latest hot stock and selling last year's disappointment. This constant activity feels like progress, but it's really just motion without direction. They are like a hummingbird, flitting from flower to flower, burning immense energy but never staying long enough to get a substantial meal. The too hard pile is the ultimate cure for the opportunity hoarder. It forces them to abandon the futile quest for breadth and embrace the profound power of depth. It teaches them that the goal is not to know a little about every company, but to know everything about a very few, select companies. It is the disciplined path away from being a collector of stock tickers and toward being a true owner of businesses. The direct financial connection of the too hard pile is one of the most underappreciated but powerful drivers of long-term wealth. It manifests in the drastic reduction of two major wealth destroyers: transaction costs and taxes. The opportunity hoarder we just described is a perfect example of a high-turnover investor. They are constantly buying and selling, reacting to news, chasing trends, and cutting positions that make them uncomfortable. Every single one of those transactions incurs a cost. While brokerage commissions may be low or even zero these days, there is still the bid-ask spread, the small difference between the price you can buy a stock for and the price you can sell it for. Over hundreds of transactions, these small costs add up to a significant drag on performance, but the far more insidious cost is taxes. When you sell a stock that you've held for less than a year at a profit, that gain is typically taxed as short-term capital gains, which is taxed at your ordinary income tax rate. This can be as high as 37% at the federal level, plus state taxes. When you sell a stock you've held for more than a year, it's taxed at the much lower long-term capital gains rate. The high-turnover investor is constantly realizing short-term gains and giving a huge portion of their profits away to the government each year. The disciplined investor who uses a too-hard pile, on the other hand, develops a low-turnover, focused investing style. Because they do so much work up front to select only businesses they understand deeply, they buy with the intention of holding for many years, if not forever. This is the essence of value investing. This buy-and-hold approach is incredibly tax-efficient. By not selling, they allow their investments to compound year after year in a tax-deferred manner. The money that would have been paid in taxes remains invested, working for them. Let's quantify this. Imagine two investors, both starting with $100,000 and earning a pre-tax return of 10% per year for 30 years. Investor A is an opportunity hoarder with a high turnover strategy. They realize all their gains each year and pay a 30% short-term capital gains tax. Their after-tax return is only 7%. After 30 years, their portfolio is worth about $761,000. Investor B is a disciplined, low-turnover investor. They let their gains compound and only pay the 15% long-term capital gains tax at the very end. After 30 years, their pre-tax portfolio is worth over $1.74 million. Even after paying taxes at the end, their net worth is substantially higher than Investor A's. The difference is hundreds of thousands of dollars. That difference is the direct financial reward of having the discipline to say no most of the time. The too-hard pile isn't just a conceptual tool for risk management. It is a practical mechanism that directly leads to a more concentrated, low-turnover, and therefore vastly more tax-efficient investment strategy. It is a tangible and massive financial advantage. Our third pillar delves into the powerful psychological forces that pull us away from this disciplined path. We must understand the siren song of complexity. Why we chase what we don't understand. Even with a well-defined circle of competence and a system for rejection, we are all susceptible to cognitive biases that tempt us to venture into dangerous territory. These temptations are the primary cause of major investment mistakes. For our foundational anecdote, we must look at one of Buffett's own self-proclaimed major errors, a mistake that is especially instructive because it involved a business that seemed deceptively simple. The company was Dexter Shoe Company. In 1993, Berkshire Hathaway acquired Dexter for $433 million. On the surface, it looked like a classic Buffett investment. It was a well-established American manufacturing company based in Maine, making high-quality, durable shoes. It had a strong brand, a loyal customer base, and a long history of profitability. It seemed like a simple, understandable business with a durable competitive advantage, or what Buffett calls a moat. The problem was that the moat was not as durable as he thought. Buffett made two critical errors in his analysis. The first was a failure to fully appreciate the looming threat of foreign competition. He underestimated how quickly low-cost manufacturers in other countries could replicate and then surpass Dexter's quality at a fraction of the price. The competitive landscape was changing in a way that was more complex and global than his previous experience had prepared him for. The seemingly simple shoe business was, in fact, subject to the complex dynamics of global trade and labor arbitrage, a factor that was outside his deepest circle of competence at the time. His second and far more costly error was how he paid for the company. Instead of paying with cash, he paid with Berkshire Hathaway stock. He exchanged 203 shares of Berkshire Class A stock for a business that would soon become worthless. In his 2007 letter to shareholders, Buffett wrote about this mistake with brutal honesty. He said, "I gave away 1.6% of a wonderful business, one now valued at $220 billion, to buy a worthless business. To date, Dexter is the worst deal that I've made." Those Berkshire shares, if held by the sellers, would eventually be worth billions of dollars. The Dexter shoe story is a powerful and humbling lesson. It demonstrates that a business can be classified as too hard, not just because its technology is complex, but also because the threats to its competitive advantage are complex and difficult to foresee. Buffett thought he was buying a simple castle with a durable moat, but he failed to see the new, powerful cannons that globalization was aiming at its walls. This mistake reinforced his commitment to not just understanding the business itself, but understanding all the forces that could potentially harm it. It taught him that if you cannot confidently identify and analyze the key variables that determine a company's long-term success, then that company, no matter how simple it appears on the surface, belongs in the too hard pile. It was a multi-billion-dollar lesson in the dangers of straying, even slightly, from the core of one's competence. The psychological principles that drive us to make mistakes, like the Dexter shoe acquisition, are deeply ingrained in our human nature. Two of the most powerful are social proof and herd bias. Humans are social creatures. We have evolved to look to others for cues on how to behave, especially in situations of uncertainty. When we see a large group of people doing something, we assume it must be the right thing to do. This is social proof. In financial markets, this manifests as herd bias. When a stock or an asset class starts to rise in price, it attracts more buyers. Is there a clear track record of profitable growth? Is the balance sheet strong? Or do the numbers reveal a business that has consistently lost money, diluted shareholders, and taken on massive debt? This exercise acts as a powerful clarifying agent. It forces you to confront the reality of the business, stripped of its seductive narrative. If the investment case collapses without the story, you know you are likely falling for the narrative fallacy. It reveals whether you are investing in a proven business or gambling on a speculative story. For a business to be a candidate for your inner circle of competence, the investment case must be compelling based on the right side of the page alone. The story on the left should be a bonus, not the main event. The antithesis to this disciplined approach is the investor archetype we can call the genius chaser. This person is drawn to complexity not in spite of the difficulty, but because of it. They equate complexity with sophistication and high potential. Their investment portfolio is a reflection of their desire to feel intelligent and forward-thinking. The genius chaser loves to invest in fields they believe are the exclusive domain of the very smart. They'll talk at cocktail parties about their holdings in quantum computing, personalized gene therapy, or fusion energy startups. They read technical white papers that they only partially understand, and they are impressed by management teams that use a lot of impenetrable jargon. They see this complexity as a moat, believing that if a business is hard to understand, It must be hard for competitors to replicate. They fail to realize that if it's too hard for them to understand, they have absolutely no way of judging whether the company's claims are legitimate or if its moat is real. Their decision-making process is a form of intellectual vanity. They aren't trying to find simple, predictable, cash-generating machines. They are trying to find the next Albert Einstein in the corporate world. They are attracted to visionary CEOs with grand, world-changing ambitions, often overlooking a lack of business acumen or financial discipline. Their portfolio is not built on a foundation of risk management or capital preservation. It is a collection of high-risk, binary bets. Each company is either going to change the world and be worth 1,000 times its current price, or it's going to go to zero. There is very little middle ground. The inevitable result of this strategy is extreme volatility. Their portfolio will experience breathtaking rises during periods of market speculation and euphoria, reinforcing their belief in their own genius. But it is also exceptionally fragile. When sentiment turns, or when the promised technological breakthroughs fail to materialize into actual profits, their portfolio is subject to catastrophic collapses. The genius chaser's fatal flaw is confusing a complex technology with a good business. A brilliant scientific idea is not the same as a durable competitive advantage. The path from a laboratory breakthrough to $1 billion in annual profit is long, uncertain, and fraught with peril. By chasing complexity, they are essentially buying lottery tickets, hoping that one of their brilliant but unprofitable companies will defy the odds and become the next Amazon. It is a strategy built on hope, not on the rational analysis of proven business models. The direct financial connection here is the devastating mathematics of large losses, which is the primary danger of venturing outside your circle of competence. As we've touched on before, the math of loss is not intuitive, it is asymmetric. If you lose 10% on an investment, you need an 11% gain to get back to even. If you lose 20%, you need a 25% gain. But when you start to experience the massive losses that are common with speculative complex investments, the numbers become terrifying. A 50% loss requires a 100% gain to recover. A 70% loss requires a 233% gain. And a 90% loss, a common occurrence when a speculative bubble bursts, requires a 900% gain just to break even. Chasing complexity and investing outside your circle of competence dramatically increases the probability of these large, portfolio-crippling losses. When you don't truly understand the business or the technology, you have no way to properly assess the range of potential outcomes. You are flying blind. A strategy that prioritizes avoiding these big mistakes is, over the long run, mathematically superior to a strategy that focuses on trying to hit home runs. Let's imagine two investors over a 40-year period. Investor A is the genius chaser. They have some spectacular years, earning 50% returns, but they also suffer several 50% drawdowns along the way. Their average annual return might look impressive. Investor B is the disciplined circle of competence investor. Their returns are more modest and boring. They aim for steady, consistent growth, and their primary goal is capital preservation. They might never have a 50% up year, but they also assiduously avoid a 50% down year. Over 40 years, Investor B's final wealth will almost certainly be multiples of Investor A's. Why? Because they avoided the devastating setbacks that force you to start over. They allowed the engine of compounding to work its magic, uninterrupted. The financial benefit of staying within your circle of competence is not about maximizing your upside in any given year. It is about minimizing your downside over a lifetime. It is a defensive strategy, and in the long game of investing, a good defense is far more important than a flashy offense. By saying no to the siren song of complexity, you are not being timid. You are being a professional risk manager. You are protecting your capital from the single greatest threat it faces, your own ignorance. Our fourth pillar shifts focus from the investment ideas themselves to the most critical resource you possess as a decision maker, your own mind. This is the economics of attention, conserving mental and financial capital. In an age of infinite information, the scarcest resource is not money, it is focused, undivided attention. A ruthlessly curated, too-hard pile is the ultimate tool for protecting and allocating this resource effectively. The foundational anecdote for this principle is not a single transaction, but the very structure of Warren Buffett's daily life. It is a life designed, with monastic discipline, for the sole purpose of eliminating distraction and maximizing time for deep thought. If you were to look at Buffett's official schedule for any given day, you would be shocked by how empty it is. There are no back-to-back meetings. There are no quarterly budget reviews. There are no frantic calls with brokers. For decades, he famously did not have a computer or a stock terminal on his desk. He has a single phone, and he rarely uses it. His office in Omaha is quiet, almost library-like. His diet is famously simple, freeing him from the mental energy of deciding what to eat. He lives in the same modest house he bought in 1958. All of these choices are part of a deliberate system to minimize what psychologists call cognitive load. He understands that every small decision you make, what to wear, what to eat, which email to answer first, drains a small amount of your finite mental energy. He structures his life to eliminate as many of these trivial decisions as possible, so that he can dedicate his entire mental bandwidth to the few decisions that truly matter: how to allocate Berkshire Hathaway's capital. The majority of his workday is spent in a simple, old-fashioned way, sitting in his chair and reading. He reads for 5 to 6 hours a day. He reads annual reports, trade journals, newspapers, and books. He is not skimming for hot tips. He is slowly, patiently, and methodically absorbing information, building and deepening his understanding of businesses and industries within his circle of competence. He is not reacting, he is thinking. Now contrast this with the life of a typical Wall Street fund manager or even a retail investor. Their days are a whirlwind of frantic activity. They are glued to their screens, watching the market's every tick. Financial news channels blare in the background. Alerts and notifications are constantly popping up on their phones. They are in a perpetual state of reaction, consuming a torrent of low-quality information and noise. They believe this constant engagement makes them better investors. But the opposite is true. They are so busy processing the noise of the present that they have no time to contemplate the long-term trends that truly drive wealth creation. Buffett's empty schedule is not a sign of laziness. It is the ultimate competitive advantage. He has recognized that great investment ideas are rare. They do not come from a live updating stock ticker or a talking head on television. They come from quiet, uninterrupted thought, from the slow accumulation of deep knowledge. His entire life is an object lesson in the economics of attention. By ruthlessly saying no to almost everything, meetings, calls, news alerts, social events, he creates the vast empty space required for a truly great idea to emerge. His too-hard pile is not just for stocks, it is for life itself. The psychological principles that Buffett is masterfully navigating here are the endowment effect and the sunk cost fallacy. These two biases work in tandem to make it incredibly difficult for us to discard ideas, even when we should. The endowment effect, identified by behavioral economists like Richard Thaler, describes our tendency to overvalue things simply because we own them. In a classic experiment, people who were given a coffee mug demanded a significantly higher price to sell it than the price they themselves would have been willing to pay to acquire it. Ownership, it seems, creates an emotional attachment. This applies to ideas as much as it does to physical objects. Once we invest time and energy into researching a particular stock, we begin to feel a sense of ownership over that idea. It becomes our stock. We are no longer objective analysts. We are defenders of our own intellectual territory. This makes it very difficult to discard the idea, even if new evidence suggests it's a poor investment. This leads directly to the sunk cost fallacy. This is the irrational belief that you must continue a course of action because you have already invested significant resources, time, money, or effort in it. It's the voice in your head that says, "I've already spent 20 hours researching this company. I can't just give up now and admit I wasted my time." We've all experienced this. We sit through a terrible movie because we've already paid for the ticket. We continue pouring money into a failing project because we've already invested so much. In investing, the sunk cost fallacy is a portfolio killer. It causes us to hold on to losing positions, hoping they'll come back, because selling would mean admitting we made a mistake and that our initial research effort was wasted. The too hard pile, when used with discipline, is the perfect antidote to both of these biases. By having a pre-committed set of rules for immediate disqualification, our inversion test, we can discard an idea before we invest significant time and effort into it. We cut our cognitive losses early. We prevent the endowment effect from taking hold. The decision is not, "Is this a good stock?" but rather, "Does this stock even belong in the category of things I'm willing to analyze?" If the answer is no, it gets tossed onto the pile before any emotional or intellectual attachment can form. This process requires a degree of ego suppression. It requires you to admit, quickly and without shame, that you are not qualified to have an opinion on a particular subject. It replaces the emotional, ego-driven process of analysis with a rational, system-driven process of filtration. It frees you from the psychological trap of sunk costs and allows you to allocate your precious mental capital only to those few ideas that have survived a rigorous and objective screening process. To put this into practice, we can use one of Buffett's most famous thought experiments as our applied mental model, the 20-slot punch card. This is a powerful psychological tool for cultivating the mindset of extreme selectivity and conserving your mental capital. Here's the analogy as Buffett tells it. Imagine that when you are born, you are given a punch card with only 20 slots on it. These 20 punches represent the total number of investments you are allowed to make in your entire lifetime. Once you've used up your 20 punches, you're done. No more investments. Every time you buy a stock, you have to punch a hole in your card. Now think about how that would change your decision-making process. You would become incredibly careful about what you choose to invest in. You wouldn't swing at mediocre ideas. You wouldn't take a flyer on a speculative tip from your brother-in-law. You would wait, patiently, for an opportunity that was so overwhelmingly good, so certain in its outcome, that you would be willing to use one of your precious, irreplaceable slots on it. Here is the blueprint for applying this mental model. First, visualize or even physically create your 20-slot punch card. Draw 20 circles on a piece of paper and put it on your desk where you can see it. This makes the abstract concept of scarcity tangible. Second, before you even consider making an investment, you must subject it to the punch card question. Is this opportunity so good, so clearly within my circle of competence, and so attractively priced that I am willing to commit one of my 20 lifetime punches to it? This question dramatically raises the bar for what constitutes a yes. It forces you to move beyond, "Is this a pretty good idea?" to, "Is this one of the best ideas I will ever have in my life?" It shifts your mindset from that of a speculator who is looking for a quick profit to that of a true capital allocator who is making a long-term commitment. Now, of course, this is not a literal rule. You will likely make more than 20 investments in your life. The punch card is not a restriction, it is a mental framework. It is designed to instill a sense of profound seriousness and discipline into your investment process. It forces you to do the hard work, to do the deep research, and to wait for the truly exceptional pitch. It is the ultimate defense against the opportunity hoarder mentality. It makes saying no the default response, and yes, a rare and deeply considered exception. By internalizing the logic of the 20-slot punch card, you will naturally conserve your mental and financial capital. You will spend less time chasing mediocre ideas and more time deepening your understanding of the truly great ones. You will trade less, think more, and your long-term results will be transformed. The antithesis of this focused, disciplined approach is an archetype we can call the information junkie. This is the person who fundamentally believes that more information leads to better decisions. Their life is a constant, frantic quest to consume every possible bit of financial data. Their day starts and ends with financial news. They have multiple screens on their desk, one displaying scrolling stock tickers, another with live charts, and a third with a financial news network playing on mute. Their phone is a cacophony of alerts from various apps, notifying them of every market move, every analyst upgrade or downgrade, and every breaking news story. The information junkie is subscribed to a dozen newsletters, is a member of several online investment forums, and listens to financial podcasts during their commute. They are drowning in a sea of information, but they are starving for wisdom. They mistake the constant flow of data for the acquisition of knowledge. They believe that if they can just process enough information fast enough, they can gain an edge. The tragic irony is that their behavior produces the exact opposite result. Their constant exposure to market noise keeps their mind in a state of perpetual reactivity. They are always thinking about the next hour, the next day, or the next week. They have no mental space for the deep, quiet, long-term thinking that is the hallmark of great investors. Their mental capital is not being invested. It is being spent, depleted by the minute on low-value, ephemeral information. This frantic activity is a form of intellectual insecurity. The information junkie is afraid of missing something. They believe that the secret to wealth is hidden in some obscure data point or some breaking news story, and if they just look hard enough, they will find it. They fail to understand that the real edge comes not from knowing more than everyone else, but from knowing a few important things more deeply than everyone else, and having the temperament to act on that knowledge. The information junkie's portfolio is a reflection of their mind, cluttered, chaotic, and short-term oriented. They are constantly trimming positions, adding new ones, and reacting to the day's headlines. They are playing the market's game, a game that is incredibly difficult to win. The disciplined investor, by contrast, refuses to play that game. They have opted out of the information arms race and have chosen instead to focus their attention on the slow, patient accumulation of genuine understanding. The direct financial connection here is the immense and often invisible power of opportunity cost. Opportunity cost is one of the most fundamental concepts in economics. It means that the cost of any action is the value of the next best alternative that you have foregone. This applies to your attention just as it does to your money. Every hour you spend analyzing a complex business that is clearly in your too hard pile is an hour you are not spending deepening your knowledge of a simple business that is squarely within your circle of competence. This has a massive, quantifiable financial impact over the long term. Let's create a scenario. Investor A and Investor B both have 1,000 hours to dedicate to investment research over the next 5 years. Investor A is the information junkie. They spend their 1,000 hours researching 100 different companies across 20 different industries. They spend an average of 10 hours on each company, which is enough to learn the basics, read a few quarterly reports, but not enough for true mastery. Investor B is the disciplined focuser. They use their too hard pile to immediately discard 98 of those industries. They decide to dedicate their entire 1,000 hours to becoming a world-class expert on just 2 industries they already have some familiarity with, say the railroad industry and the insurance industry. They read every annual report going back 30 years. They read the biographies of the great industry leaders. They understand the regulatory environment, the competitive dynamics, and the key drivers of profitability better than 99.9% of other investors. Now imagine that one day, due to some short-term market panic, the stock of a fantastically well-run railroad company falls 50% in a week. Investor A, the information junkie, might notice this. It's one of the 100 companies on their watch list. But their knowledge is superficial. They get scared like everyone else. They don't have the deep conviction to act. Maybe they'll take a small, hesitant position. Investor B, the expert, sees this event not as a crisis, but as the opportunity of a lifetime. They understand the business inside and out. They know that the market's short-term fear is disconnected from the company's long-term earning power. They have the supreme confidence born of deep knowledge. They will act decisively, betting big, perhaps allocating a significant portion of their portfolio to this single, extraordinary opportunity. That single decision, made possible by 1,000 hours of focused effort, could generate a return that transforms their entire financial future. The difference in the financial outcomes for Investor A and Investor B over their lifetimes will not be a small one, it will be a chasm. That chasm is the quantifiable financial return on focused attention. It is the monetary value of having a too hard pile. We arrive now at our fifth and final pillar, which brings together all the preceding concepts into a single powerful conclusion about how wealth is truly built. This is the simplicity premium, compounding certainty, not speculation. After you have defined your circle, built a system for rejection, resisted the pull of complexity, and focused your attention, the final step is to act. And the secret is to act on the simple and the certain. The ultimate payoff of this entire philosophy is that simple, understandable businesses often provide the best and safest long-term returns. The quintessential foundational anecdote for this pillar is the story of one of Buffett's earliest and most successful investments, a business so simple and wonderful that he and Charlie Munger still speak of it with reverence: See's Candies. In 1972, Berkshire Hathaway, in partnership with Blue Chip Stamps, acquired See's Candies for $25 million. At the time, See's was a well-regarded but regional boxed chocolate company based in California. It was the absolute antithesis of a complex, high-technology business. They bought sugar, chocolate, and nuts, and they used simple recipes to make candy, which they sold in their own stores. That was it. But Buffett and Munger saw something profound in this simple business model. They saw a brand with incredible, almost fanatical, customer loyalty. Generations of families had grown up with See's Candies as a central part of their holiday traditions. This deep emotional connection gave the company a durable competitive advantage that was almost impossible for a competitor to replicate. It created what Buffett calls pricing power. See's could raise its prices year after year to cover inflation and then some, and customers would not bat an eye. They weren't just buying chocolate. They were buying nostalgia, tradition, and a guarantee of quality. The purchase of See's was a pivotal moment in Buffett's evolution as an investor. It taught him that it was better to pay a fair price for a wonderful business than a wonderful price for a fair business. The economics of See's were simple and predictable. It didn't require huge amounts of capital reinvestment. It had no patent cliffs to worry about. It wasn't going to be disrupted by a new technology. It was just a cash-generating machine. And generate cash it did. That initial $25 million investment has since returned over $2 billion in pre-tax profits to Berkshire Hathaway, and the company is still growing and thriving today. The cash flow from See's provided the capital for many of Berkshire's other acquisitions. It was a gusher, as Buffett would call it. The story of See's Candies is the perfect illustration of the simplicity premium. While other investors were chasing complex conglomerates or exciting electronics companies, Buffett bought a business he could understand completely. He wasn't speculating on future growth. He was buying a current, predictable stream of cash flow that he was confident would continue for decades to come. He was compounding certainty. And the results have been nothing short of extraordinary. It proved that you don't need to invest in complex, hard-to-understand businesses to achieve world-class returns. In fact, more often than not, the opposite is true. The underlying psychological principle that makes investing in simple businesses so powerful is our innate human tendency of ambiguity aversion. This is the well-documented finding that people prefer known risks over unknown risks. We would rather choose an option with a known probability of success even if it's low, than an option with an unknown, ambiguous probability of success. In a classic experiment, people are offered a choice to draw a ball from one of two urns to win a prize. Urn A contains 50 red balls and 50 black balls. Urn B contains 100 balls, but the mix of red and black is unknown. Most people will choose to draw from Urn A. The probability of winning from Urn A is a known 50%. The probability of winning from Urn B could be anything from 0% to 100%. Even though the expected probability from Urn B is also 50%, we shy away from the ambiguity. We prefer the certainty of the known. Let's apply this to investing. A simple, established business like See's Candies is like Urn A. The risks are relatively known and quantifiable. You can analyze its brand strength, its historical pricing power, and the stability of its customer base. You can make a reasonably confident forecast of its future earnings. The range of potential outcomes is relatively narrow. A complex, speculative business, like a biotech firm with a single drug in phase 2 clinical trials, is like Urn B. The risk is ambiguous and unquantifiable. The drug will either succeed, making the stock worth a fortune, or it will fail, making the stock worthless. There is no way for an outside investor to know the true probability of success. The range of outcomes is incredibly wide. By sticking to simple businesses within his circle of competence, Buffett is aligning his investment strategy with this fundamental aspect of human psychology. He is deliberately choosing to play in Urn A. This has a huge impact on the quality of decision-making. Investing in ambiguous situations creates immense psychological stress. It leads to second-guessing, emotional reactions, and a tendency to sell at the worst possible time. Investing in businesses with known risks and predictable outcomes, on the other hand, allows for a much more rational and detached temperament. It reduces the stress of investing and enables you to think like a long-term business owner rather than a short-term speculator. The simplicity premium is, in part, a psychological premium. You are rewarded not just for finding a good business, but for finding a business whose predictability and clarity allow you to behave rationally through the inevitable ups and downs of the market. To translate this into a practical, applied mental model, we can use a simple but powerful filter called the 10-year test. This is a thought experiment you should run on any potential investment before it can be considered for your 20-slot punch card. The test consists of asking yourself a series of simple questions about the business and its industry, looking out over a 10-year horizon. Step 1. Can you, with a high degree of confidence, describe what this industry will look like in 10 years? Will it be bigger or smaller? Who will the major players be? How will the technology have changed? For some industries, like soft drinks or insurance, the 10-year view is reasonably clear. For others, like social media or artificial intelligence, it is incredibly murky. If you can't confidently describe the industry's future landscape, the business fails the test. Step 2. Will the company's core product or service still be in high demand in 10 years? This is a question about the durability of human behavior. Will people still be drinking Coca-Cola? Yes, almost certainly. Will people still need to insure their homes and cars? Yes. Will people still be using the dominant social media platform of today? Maybe, maybe not. The test favors businesses that tap into basic, enduring, human needs and desires. Step 3. Will this company likely still have its competitive advantage in 10 years? What is the source of its moat, and how durable is it? Is it a powerful brand like See's Candies? Is it a low-cost production process like Geico? Is it a network effect like American Express? You must be able to clearly articulate the moat and then explain why it will not be eroded by competition or technological change over the next decade. If the answers to these questions are filled with words like maybe, if, or it depends on a specific technological breakthrough, then the business is too unpredictable. It is not understandable in the Buffett sense of the word. It fails the 10-year test, and it belongs squarely in the too hard pile. This mental model is a powerful antidote to short-term thinking. It forces you to ignore the quarterly earnings cycle and the daily market chatter, and to focus instead on the long-term structural characteristics of a business. It filters for durability, predictability, and certainty. It is the final gatekeeper that ensures only the highest quality, most understandable businesses ever receive your capital. The antithesis of this approach is the all-too-common archetype of the story stock gambler. This investor is not interested in the boring certainty of a candy company. They are addicted to the thrill of the unknown, the allure of the explosive growth narrative. Their portfolio is a collection of high-risk bets on speculative stories about the future. The story stock gambler is constantly searching for the next Amazon or the next Tesla. They invest in electric vehicle startups that have never produced a car, space exploration companies with no revenue, or gene editing firms with promising but unproven technology. Their investment thesis is not based on current cash flows, a strong balance sheet, or a proven track record of profitability. It is based entirely on a compelling and often hypnotic story about what the company could become 5 or 10 years from now. They are not buying a business, they are buying a dream. They are in effect venture capitalists, but without the access, diversification, and deep technical expertise of professional venture capitalists. They are playing an incredibly difficult game with a massive informational disadvantage. The story stock gambler is highly susceptible to the narrative fallacy and herd bias. They get caught up in the hype cycles of the market, buying into hot sectors at their peak and then riding them all the way down. Their portfolio is characterized by extreme volatility. It will soar during speculative manias, making them feel like a genius. But it is also prone to devastating 80% or 90% drawdowns when the story falls apart or the market sentiment shifts. They are constantly swinging for the fences, trying to hit a grand slam. They don't understand that the key to long-term wealth is not hitting home runs but simply avoiding strikeouts. The disciplined value investing approach is about hitting singles and doubles consistently, year after year, and letting the power of compounding do the heavy lifting. The story stock gambler rejects this path as too slow and boring. They crave the excitement of the big win, and in doing so, they expose themselves to the certainty of the catastrophic loss. This brings us to the ultimate direct financial connection, the mathematical engine that drives all long-term wealth creation, the power of compounding. Albert Einstein supposedly called compound interest the eighth wonder of the world. He who understands it earns it. He said he who doesn't pays it. Compounding is the process of generating earnings on an asset's reinvested earnings. It is a snowball effect, but this magical engine has one critical vulnerability. It only works its magic if you avoid major setbacks. The entire philosophy of the circle of competence, the too-hard pile, and the focus on simple certain businesses is designed to protect the compounding machine from being derailed. Let's look at the numbers one last time. Imagine an investment that returns a volatile 15% per year on average, but suffers a 50% drawdown once every decade. Now compare that to a boring investment that returns a steady, consistent 12% per year with much smaller drawdowns. Over a single 5-year bull market, the volatile investment might look superior. But over a 30 or 40-year investment lifetime, which includes multiple market cycles, the steady compounder will win, and it will win by an enormous margin. The years spent recovering from the huge losses completely wipe out the benefit of the higher returns in the good years. The superior financial advantage of the simplicity premium is not necessarily a higher peak return in a bull market. It is a much shallower decline in a bear market. This superior downside protection, this capital preservation, is the secret sauce. It's what allows your capital to keep working for you, day in and day out, without the devastating interruptions of large losses. A portfolio of simple, predictable, cash-generating businesses is a portfolio designed to survive and thrive over the long term. It is a portfolio built to maximize the relentless, unstoppable power of compounding. This is the final and most profound financial transformation that comes from adopting Buffett's mindset. You stop chasing speculative stories and start owning predictable cash flows. You stop gambling and start investing. You stop compounding speculation and you start compounding certainty. You have just spent this time acquiring a powerful mental tool. You've learned not just about Warren Buffett's circle of competence, but about the deeply practical operational system he uses to defend it, the too hard pile. You now have the blueprint to stop chasing the 99% of opportunities that are designed to distract you, deplete your energy, and destroy your capital. You have learned the architecture of ignorance, the art of active rejection, and the profound economic power of conserving your attention. This is a framework for risk management and capital preservation that can fundamentally change your financial future. But what you've mastered today is one half of a powerful equation. This is the defensive strategy. It's the moat you build around your castle. It is the critical first step in separating the signal from the overwhelming noise of the market. The next, equally critical step, is the offensive strategy. Once you have cleared away the 9999 things you must ignore, how do you analyze the one or two that remain? Knowing what to discard is the foundation, but knowing what to look for in that small, select pile of opportunities is how a fortune is truly built. The system is a network of interconnected mental models. You've just forged the shield. Now you must learn to wield the sword. The video on your screen right now is not just another piece of content. It is the missing link. It's the other half of the map. It is the set of lenses you need to examine what's left after the too hard pile has done its job. You have taken the first decisive step on the path from being a speculator tossed about by the whims of the market to becoming a true investor, a disciplined allocator of capital. The question that remains is, will you complete the journey? The disciplined mind builds the too hard pile. The master investor knows precisely what to do with the few precious opportunities that remain. The choice to continue that evolution from defense to offense, from amateur to professional, is yours. Click and complete your mental arsenal.